This has been such an interesting situation for the last 6 weeks because physical silver has been in short supply with the U.S. Mint closed, the Royal Canadian Mint closed. And so you've got the paper trading price where, they trade these futures contracts on the COMEX and in London at $15. But if you actually want to buy some, you can't buy it at $15. You got to go onto eBay or, go to a dealer or something and pay $25. So what really is the price?
Welcome back to Liberty and Finance and Reluctant Preppers. We have a returning guest, Craig Hemke, as the founder of the TF Metals Report. He joins us again this Monday, May 11th, 2020. Craig, thanks for joining us.
Always good to see you, Dunnigan.
We have several questions that have been entered by viewers ahead of your interview here, but before we get to them, I wanted to give you a chance to give us a quick update on your perspective on the economic impact on a world gone mad, both from the policy impacts that have basically shut down the global economy or what was left of it, and then the rescue measures that have been put into place and the impact that all of those are having on the real economy and people's lives, and where you see that playing out in the next few months here.
Well, I'll spare you my normal 15-minute monologue, Dunnigan, because that, you get me started, I can usually just go on and on and on. It's going to have a positive impact on the precious metals. I don't think there's any doubt about that. And at the end of the day, what's happening now is the Fed is trying desperately to re-inflate, reliquefy the economy. We had $4, $5, $6 trillion basically evaporate stock market value. And you can take that across the board, bond market, anything, real estate values, whatever, lost GDP from all of these shutdowns. And the impact is dramatic across not only the markets, but local governments, local economies, and the like. And so the Fed is desperate to print cash, monetize the government debt, right? Because the government's the one that then distributes the cash, and get it out there. What they're doing then is rapidly increasing the money supply. For now, that is not showing up as an inflationary pressure. And you've seen, for example, the price of gold has, rallied about $300 once this QE plan was announced back on March 23rd. Now it's given back about $100. And it's in a period here where we're actually dealing with kind of a negative fundamental for gold, which is what we call a positive real interest rate, meaning that we're now in a deflationary environment. So even with interest rates at these historic lows under 1%, when you subtract a negative inflation rate, you get a positive number, a positive return. And that's typically not very good for things like gold. But where we're headed now, eventually, is into a period of steeply negative real interest rates. May even get negative interest rates just in general. We started hearing about that last week. And once that happens, we're enter a period of kind of a stagflation, if you will, a lot like the 1970s, where we didn't have much economic growth, but we had high inflation. That's the stag is stagnant economic growth. Inflation is inflation. And that, period really existed from about 1973 all the way to 1980. You remember, Carter with his malaise and Gerald Ford with whip inflation now. And it was actually then very good time for gold and silver and precious metals miners. But it was a period of stagflation. I think that's where we're headed. The economy will slowly recover as people get back to work. But there's a lot of businesses, small businesses, are never going to reopen.
And not just small businesses. There was an article that came out today saying that significant amounts of American manufacturing, what was left of it, is closing and not expected to reopen. There's pottery manufacturers and furniture manufacturers and tire manufacturers and others that are just not going to reopen, they said.
It takes a lot of time for a demand for those kind of products to get back to where it was. And so you might either not reopen or you rehire at, 2/3 capacity, that kind of thing. You look at how they're rolling out these restaurants to reopen, at 25% capacity. Well, how in the heck does a restaurant make any money at 25% capacity. Well, one way they try to do is raise prices, right? Oh, no, we're not sure that'll work, but that's what they'll try to do. And that's all part of this inflation that's coming. So anyway, it's going to be a long, long road to recovery. This idea of a V-shaped, where you just go straight down and then straight back up, I don't think that's likely at all. And then when you start hearing people like, you hear some of these economists talk about positive GDP growth in the third quarter, it just is almost impossible from a mathematics standpoint. Right now, the second quarter, which we're about halfway through, we've seen it in the forecast. The Atlanta Fed has a forecast of like negative 35% GDP growth. It's just astonishing when you think about it. But anyway, that's for the second quarter. We're halfway through the second quarter. And so when you work it out then month by month through the third quarter, if you start out July negative 10%, what do you have to average then in August and September to eke out a positive number? So, plus 20% or something, So it's going to be a long time until we get, any type of roaring economy again. But the impact of all this debt creation and debt monetization and fiat money creation is going to really be felt across the economy, that's for sure.
Now, today we also had an announcement. Last week and the week before, it was the Fed saying that they have unlimited resources to help out the banks. And then this week it was, we saw last week again, buying up of junk bonds and so on, and corporate bonds starting. And now they're talking about unlimited funds to backstop the banks in numerous different ways.
Yeah.
I guess if you could just help people understand, help me and others understand, what does that even mean when the Fed says they have unlimited resources to backstop the banks? How is that going to help ordinary people to get back to work or help us get our actual economy back on the ground?
Yeah, that's the big lie. Where they tell you that, oh yeah, if we rescue the banks, then everything's going to be just fine. Bernanke told that lie back in 2008 and 2009, lied to Congress. Made all these stories up about how Main Street was failing. No, Wall Street was failing. And so they shore up the banks. Remember, the Fed is a private corporation owned by its member banks.
Coincidentally.
And so when they create cash to buy stuff from the banks, which is what they've done before back in 2008 and 2009, or when they create cash to buy the debt of the U.S. as the U.S. issues, the U.S. is going to have, a $6 trillion deficit this year? And people say, well, where's that money going to come from? Like, we're going to go borrow it from China or Germany or Japan or someplace. Oh, they'll borrow a little, I suppose, maybe. Mainly, it's just the Fed creating new cash and buying the bonds from the Treasury Department and flooding that cash out there. So, this notion that the Fed is looking out for the little guy. Man, I just saw today a chart based on the Fed's own data showing that any impact of all of the money printing since 2009 has all gone to everybody in the top 10% earnings category. Most of it, the lion's share of it, gone to the top 1% in that earnings category, where people in the bottom 20% have actually seen their financial situation get worse in the last 12 years. Or look at the math this way. I saw this back when all these things were being floated 6 weeks ago with that first stimulus plan, or whatever they wanted to call it, was something like $2 trillion. Remember that? And it was all these loans to banks and all this other jazz. And part of that was this, $1,200 to you and to me and for just about everybody listening to us. Well, that whole plan, somebody just kind of ran the numbers and kind of rounded up and, kind of even it off to make it sound, even more catchy. But that plan added about $12,000 per taxpayer in obligation to the national debt. Okay, for your $12,000 in extra obligation, you got a check for $1,200. It's kind of how it worked, and that was just that first plan, that first, the thing that included the Paycheck Protection Program or whatever they called it, and those stimulus checks that everybody was supposed to get. And then, lastly, I just watched the evening news tonight. And they're still talking about people that either A, haven't gotten that check yet, or B, can't get through to their state unemployment office to file for initial unemployment claims. And so you got all these poor people that have been laid off from their jobs, living paycheck to paycheck in the first place, and they've gotten a grand total of squat so far. But yet, the Fed creates all this cash, the banks are getting by, and the stock market's up 28% in the last 7 weeks. I don't know, man. This is all part of the stuff that makes me really nervous about, you and I have been talking about this for 5 or 6 years and now about just kind of societal unrest, that at some point, this type of system just can't continue because you just can't keep benefiting the few at the expense of the many. And man, this latest situation, it's even worse than ever before.
What do you think it would take for, as the Fed continues to use that term unlimited, we have unlimited,
Yeah.
for people, the ordinary taxpayer to say, well, then why am I paying taxes?
Yeah, I know. Yeah, exactly. What's the point of paying taxes? Let me put it this way. Let me phrase this in a more economic sense. The U.S. government for fiscal year 2020, which began October 1st of last year and concludes end of September this year, was projected already to run a budget deficit of $1.1 trillion. If you want to do the math on it, it was roughly $4.1 trillion in spending and about $3 trillion of revenue, tax revenue, fees, tariffs, all this other jazz. The difference, the $1.1 trillion, that's your deficit, right? Well, the problem now is we're going to spend far more than $4.1 trillion, all this other stuff. It's going to be closer to $8 or $9 trillion by the time it's all said and done. And on the tax revenue side, because the economy is ground to a halt, they're not going to bring in $3 trillion. They'll be lucky to bring in $2. And so your deficit now is going to be like $6 or $7 trillion, which is what we were just talking about. Okay. Well, then to your question, your point is, why the hell even collect the other $2? If the Fed's just going to monetize it, have them monetize the whole darn $9 trillion. Why are you going to collect $2 trillion from every, you know what I mean?
Seems that would give individuals immediately, without having to wait for their stimulus check, it would give them immediately that ability to direct more of their own finances. Yeah.
It's kind of like the minimum wage argument in some sense. It's like, well, $10 isn't fair, so it should be 15. Well, hell's bells, make it 50. If we're just going to start giving stuff away, then, if the Fed's going to monetize the, 80% of the debt and the deficit, why not do the whole thing? And I guess, that's some of the argument that these modern monetary theory people make. They just say, screw it, just monetize everything, give everybody universal basic income, do all. And that may be, frankly, it's not something I think could be smart, but I think maybe that's the direction we're headed. Eventually, what I suspect is, like all monetary systems of the past however many millennia, this one will fail as well, because look, if a magic money tree worked, human beings would have perfected it centuries ago, but it doesn't work. And eventually it'll swing back, into some form of sound money. But in the meantime, yeah, your point is well taken.
But your point as well is that as soon as it becomes official policy that the Fed is just going to keep creating whatever it takes to expand our debt, and there aren't actual buyers of that debt, then what happens to the U.S. dollar?
Yeah, and I remember you and I talking about this the last time we spoke. On a relative basis to the other paper currencies around the world, it may just go sideways, because we measure the dollar as a dollar index. If you watch CNBC or Bloomberg or read the paper, they say, well, the dollar rose today. And what are they quoting? They're quoting the dollar index. Well, what's a dollar index? A dollar index is a basket of all these other foreign currencies, mainly the euro. It's like about 60%. But also, the British pound and the Japanese yen and the Canadian dollar, and you name it. And it's kind of a weighted index of all those currencies versus a dollar. Well, just by definition, if the dollar's devaluing at roughly, that's being created from nothing at roughly the same rate as the ECB is creating euro, and the Bank of England is creating pound, the Bank of Japan is creating yen, then they all kind of sync together. And on a relative basis, there's no change. It's like you and the fly are both doing 80 miles an hour inside your car, right? The fly's doing 80 miles an hour, but relative to you, it's not moving. right? It's kind of the same thing.
Yeah, it's a little bit more like a bunch of people in free fall who are supposed to try to pull their parachutes, but then they all decided that they're just going to go into that rocket man pose, and they're shooting down at a much higher velocity now next to each other.
Yeah. And so at the end of the day, I guess a better value, how do you say that is the dollar going up or down? Do it against something that is stable. And that's another way to look at the gold price, at least even as the way it's derived now through these derivative trading and the futures trading. Since quantitative easing to infinity was formalized and announced back on March 23, 7 weeks ago, gold's up about 14%. So has the dollar been devalued by 14%? Yeah, that's one way you could look at it.
Speaking of precious metals, we have a question from Orpheus Epiphanes who asks, do you see the total price of physical silver staying roughly the same as the spot price increases? As in, the spot price goes up, say, 10%, but the premiums drop proportionally, or will the premiums stay high as the price rises?
That's an interesting question. This has been such an interesting situation for the last 6 weeks because physical silver has been in short supply with the U.S. Mint closed, the Royal Canadian Mint closed. And so you've got the paper trading price where, they trade these futures contracts on the COMEX and in London at $15. But if you actually want to buy some, you can't buy it at $15. You got to go onto eBay or, go to a dealer or something and pay $25. So what really is the price? And that's causing a lot of people to think about it, in which at the end of the day, the banks that manage these markets and, manage the futures markets, they'll wriggle off the hook and the system will continue. But if anything, the damage has been done to some extent because more people than ever are going, wait a second here. How can it be 15 over here and 25 over there? That doesn't make any sense. And that's ultimately good for us because the only thing that will eventually finally change this is when there really is a shortage of supply, or when the world figures out that there's far less actual metal than what these futures markets make pretend there is. And that's when the physical price finally takes over. But for now, this banker system of this pricing it through derivatives trading will probably continue for a while longer.
But in this environment, do you have a sense for when, let's just say, physical demand for silver increases? Do you think what the questioner is specifically keying in on is, do you imagine that the premium will continue to be significant, or do you think that the actual spot price will increase to be a larger portion of the price that metal is actually trading at?
It'll probably come down. It has in the past. Unless, again, there's some another massive spike in physical demand that comes at a time when the mints and the miners and the refiners are shutting down, like we just had. There may be a stock market collapse will cause that eventually. I think there will be a crisis of confidence in these banks and their pricing scheme, because for now, people are willing to kind of put up with it, and say, okay, I realize that you may have taken my gold that I store at your bank and resold it 10 different times to 10 different people, but that's okay. I trust that you'll get it to me sometime when I want it. When that confidence finally fails, and who knows, that could be right around the corner, perhaps, I don't know. That's when finally there'll be, this big run up in premiums again and greater demand again. I do think, though, too, Dunnigan, that, like I said, we are heading into a period of much higher demand for precious metals in all their forms, whether it is even these futures contracts or the physical metal or the mining shares. This period that's coming, the stagflation period, is going to really shine the light on this monetary policy and how they're just creating cash from nothing, and that your cash is not a store of value at all. What really is a store is physical metal, and that added demand is going to ultimately impact things too.
Remind us, in a stagflationary environment, what we expect of the equity markets, because that's the other option that people have. They say, okay, cash is going to be no good because they're creating cash like it's going out of style, but it's propping up the stock market, so maybe they'll be tempted to leave their IRAs or 401ks or whatever alone, their brokerage accounts, if they have them, alone, thinking that that's going to be an asset that's going to be a leading indicator that the powers that be want to keep inflated as a headliner.
I'm reminded, I hadn't really thought this through until you asked the question. You obviously remember the 1970s a lot better than I do. You were in about your 40s back then, I think, Don, again. But,
Hey.
I recall, some of the stories from the 70s when I was just a young child. And, the story then was the Nifty 50. People watching us might remember the Nifty 50 were like the main 50 stocks that you wanted to own. They were really going to drive things, kind of similar to the FANGs today, though it's not 50, it's 5.
Mm-hmm.
The part of the reason why the indices are holding up there as well as they are is that the primary part of the kind of like how the euro is a big part of the dollar index. Facebook, Amazon, Netflix, Google, and the hell I'm forgetting one. Those 5, Microsoft, whatever it is, Apple, they make up the lion's share of the S&P 500 index. It's a weighted index. And so if you can just keep those 5 or 6 stocks up, you can keep the whole index up. And servers in an index fund can feel like everything's just fine. That's kind of what Nifty 50 was like back in the early part of the 70s as well. But really the decade of the 70s was kind of a sideways time for the stock market. That's probably what we're getting into here as well. But keep in mind, there's a real interest in keeping the stock market afloat in that the Fed has created this low interest rate environment. And so even your traditional institutions, your institutions that traditionally would invest in fixed income, very safe, highly rated bonds and the like, insurance companies and pension funds and things like that, they've had to get into the stock market because they can't meet their, the actuarial numbers that they've got to get, the returns they've got to get to meet their promises in the future by investing in bonds at 2%. Right. And so, everybody's levered to the stock market now. And so the Fed they're going to do everything they can to keep it from crashing.
Now, we talked about taxes earlier. We talked about precious metals. Here's a question that brings them both together. Joe Maxwell asks, why is the IRS still allowed to tax the, quote, sale of gold at the extortionate rate of 28%? Is anything being done to reverse this? First, could you address the question of why he'd put quotes around the term sale of gold as though you can buy and sell money?
Yeah, I guess that's right. Yeah, because gold is money and it has been for millennia, and you're just exchanging, when you sell your gold, you're just exchanging your gold back for cash. If I give you a 20 for your 2 10s, is that a taxable?
You're scaring me. Don't ask that out loud.
Yeah, really.
Don't give
so
him ideas.
I understand where he's coming from. I don't know. To start talking about U.S. tax policy is just not something I spent a lot of time thinking about because it's so convoluted and screwed up in the first place, right?
All right. Well, this keeps it a little bit closer in one arena here. Anna Krzylinski asks, when do you see the gold-silver ratio going to close?
Well, to answer Anna's question, it's kind of like what we were just kind of kicking at a couple minutes ago, actually, Dunnigan, is what is the gold-silver ratio? Is it the COMEX price? With $1,700 gold and $15 silver, giving you 115 or whatever that is? Or is it the eBay price? With $1,800 gold and $25 silver, giving you a ratio of 75.
Mm-hmm.
That's probably the first question you should ask. I've always thought that the reason it's so out of whack, for me personally, is it's a function of supply and demand as a derivative. When we were just pricing it off of the actual metal in the ground, that's the historical one that people cite all the time, or the amount that it comes out, 10 to 1 or 16 to 1. People think that should be the ratio in price as well, but we don't price it off of the metal in the ground. We don't price it off of an exchange of you giving me cash and me giving you metal. We price it off the trading of these futures contracts, which the banks create from nothing and flood the market, and they trade with no connection at all to the physical price. And so, why should it be surprising that the gold-silver ratio is out of whack versus what it is historically? Now, maybe you can say if we then eventually one day, I sure hope we eventually one day get back to a more fair pricing scheme, and the price of gold is discovered to actually be considerably higher than it is now, then maybe the traditional gold-silver ratio of 20 to 1 or something will come back around. But for now, as long as the price is determined through the exchange of futures contracts, which are never delivered and have no basis or connection to physical metal, then this thing's just going to, this whacked out gold silver ratio is just going to continue.
Okay, we have a question here from Bahambra Z, who asks, should holders of gold and silver coins be exchanging them for gold and silver coins made by the U.S. Mint? The fear is that the U.S. government could make it illegal to hold any coins not issued by the U.S. Mint, in spite of the fact the U.S. Constitution recognizes gold and silver as real money. What about the broader picture of legitimacy and ability to continue to hold different forms of gold and silver? What are your thoughts on that as far as mint coins versus bullion coins versus collectibles?
If Duncan, if we get into a case, 1933 all over again, they come to confiscate your metal. One, I've always said I don't think they can do that. You could go town to town in the 30s, and put up a sign saying everyone's got to bring your gold. You can't do that in 2020. I mean, in the internet, it's just not going to happen. Now they might come up with some kind of confiscatory tax thing like we were just talking about, and say, if you go to convert your gold, all of a sudden is, pick some Jim Sinclair number, $50,000 an ounce, and you go to sell your ounce of gold that you bought at $1,000, and convert, and hey, look at this, I made $49,000. They may charge you 90% windfall tax or something like that. I don't know, but I don't think the confiscation thing, but I could be dead wrong. Now some coin dealers will tell you that, well, that's why you got to own, Eagles. I don't think that holds any water at all. And I think that's just a way of getting you to buy something with a higher premium, because silver eagles typically have a higher premium attached than like silver buffaloes by the, from the Scottsdale Mint or something. Mm-hmm. And the same thing is said for collectibles. There are some dealers that say, well, you should buy, rare coins at some really high premium because, in the 30s, they were considered, antiques or art or whatever and weren't confiscated. Again, now we're in the confiscation part of this again. And that's just, again, some unscrupulous dealers, that's just another way that they try to get you to buy the higher premium stuff. I mean, to me, gold is gold, silver is silver. Buy it whatever is the least amount of premium. If it's a handheld or a hand-poured bar of silver, usually is pretty low. Then you got to lug that 100-ounce thing around. You can put it in your pockets and exercise on the treadmill with it, I suppose. But anyway, I just kind of a roundabout answer to the question. For the questioner, I just buy the gold or silver. I mean, it just is what it is. And if you pay more for it, you're really just paying a premium for something that probably is never going to happen.
We've talked about various aspects here, but we have not talked about miners yet. You did mention that in passing at the beginning. Could you give us your outlook for how you think the mining companies are going to fare through the road ahead? And there's lots of different gyrations here. We've seen partial shutdowns or complete shutdowns of some mining operations due to COVID-19, social distancing, whatever. We've seen other plunge of 35% in the broader equity markets, and coming back there. We've seen all kinds of different macro factors that are potentially could impact companies and the stock of companies like miners. What are you looking at?
Well, they are shares after all. And we all got to experience that back in early March when the stock market was collapsing and there were margin calls and liquidations and things like that. And that was brutal what happened to the miners for a couple of weeks. But like I said, now they're up. The GDX, the big gold miner ETF's up about 70% in 7 weeks since QE to Infinity started. I think you and I have talked about this a couple times already this year. My forecast for this year, which I wrote and posted back on January the 7th, was for gold to go finish the year at 1520, which was exactly what my target was last year. And we would go to 1750 to 1800 this year. We got to 1789 back on April the 14th, so we've already been there. I thought silver could make a run to 20, maybe even 22. Haven't gotten there yet. But I thought where the real gains would be found is in the mining shares because the leverage that they provide to price. Again, you can, if you're in the simplest math, if at $1,300 an ounce, say, is your all-in sustaining costs, and at $1,400 an ounce, you're making $100 for every ounce you take out of the ground. Well, at $1,600, you're making $300. So that's a triple. Your earnings just tripled. Okay, so that's incredible leverage, and we've seen that play out in these large cap mining shares that are some of them at multi-year highs, and I think that'll continue. You mentioned if the mine's closed, what happens? Well, let's think that through one more step. If the mine's closed, it's because the quarantines are going on, the virus is getting worse. And if that's the case, then the central banks are printing even more money. And if that's the case, then even while the mines are shut down, the value of the gold in the ground is going up, right? So it's not as if, they're not making, chairs or cars or refrigerators or something like that. Nobody's buying them. The product of the mining company is going up in value while it's sitting there not being mined. So that's another thing that's kind of a positive factor. So anyway, I thought this year would bring outsized gains for the mining shares in general. Yeah, you got to ride a lot up and down in volatility, but so far that's the case. It's working out quite well. And I mentioned earlier, if we are heading into a period of stagflation, man, oh man, the last couple of years of the 70s, you remember gold went from $35 pegged dollar to gold ratio back in 1971 when Nixon closed the gold window. $35 to $800 by the end of the decade, right? And a lot of that action was in those last couple of years. There's a lot of mining companies that in that kind of last final blow off in 79 and 80 went from $3 to $30, or 30 cents to $10. As everybody's just rushing to get in on the action. We're not anywhere near that point yet. Nowhere near that point yet. So as part of a diversified portfolio and a balanced breakfast, I would encourage everybody to have at least some mining shares. No doubt about that.
If people want to follow your analysis and the discussion that happens on your site, where should they go?
Well, I appreciate that. We're on this every single day, man. I guess some people use this information for trading. We follow trends, and we try to pick the optimal times to buy physical metal. If we can save a few bucks by anticipating a downdraft by knowing what the banks are going to do in the futures market, it can kind of pay for itself. Some people use, my site for trading. Hey, knock yourself out. But the site really is just a store of information provided by people around the world. All political stripes from, I think we've got somebody on every continent except Antarctica, and maybe we've got somebody down there too. And just the interaction every day between the analysis that I do and the stuff that everybody else posts, I think it's great value. It's only $12 a month, 40 cents a day. I know times are tough, but I think this is still pretty valuable for folks, especially with everything else that's going on. Again, just tfmetalsreport.com is where you'll find us.
We've been speaking with Craig Hemke, the founder of TF Metals Report. Craig, as always, thanks for joining us here on Liberty and Finance and Reluctant Preppers.
Done again. It is always a pleasure, my friend. Let's do it again soon.
If you've decided that now is the right time for you to protect your family's financial future by acquiring physical precious metals, gold and silver, I'm delighted to let you know that I have now become a licensed dealer's representative for Miles Franklin, one of the oldest and most trusted names in bullion dealerships. And we can provide you with physical delivery to your personal possession or to professional vault storage or precious metals IRAs. Just email me at libertyandfinance@protonmail.com and please include your name and phone number in your email to libertyandfinance@protonmail.com. We'll get right back with you and find out how to best meet your needs so that you can either begin or increase your acquisition of physical precious metals now and protect your family's future starting today.